It's not always easy to understand the world of asset financing and leasing. Understanding the distinction between an operational lease and a finance lease is another typical area of confusion we see. Let me attempt to explain. An operating lease is a lease other than a financial lease, according to generally accepted accounting principles, SSAP 21 and IAS 17. So, let's start by defining what a financial lease is. What is finance lease? A finance lease is a method of obtaining financing. In essence, a leasing business, the lessor or owner, purchases the item on behalf of the user, sometimes referred to as the hirer or lessee, and rents it to them for a predetermined time. A finance lease is a lease that transfers money, according to Statement of Standard Accounting Practice 21. In essence, this indicates that the lessee is in a situation that is fairly comparable to one in which they would have purchased the asset. In exchange for renting out the asset to the lessee, the lessor demands a rent payment. The asset remains the property of the lessor, but the lessee has the sole right to utilize it, providing it observes the terms of the lease. During the initial, or primary, period of the lease, the lessee shall pay rent equal to the purchase price of the asset. All of these rentals must be paid, sometimes with an additional payment due at the end of the agreement as a balloon payment. The lessor will have made a profit on its asset investment once these have all been paid. Technically, a financing lease is classified as non-cancelable even though it may be feasible to terminate early. The consumer is committed to paying these rentals during this time period. Upon expiration of the lease, the following are potential outcomes that could occur at the conclusion of the primary financing leasing period, depending on the specific agreement. The asset is returned to the lessor to be sold. The lessee sells the asset to a third party acting on behalf of the lessor. The customer enters into a secondary lease period. When the asset is sold, the customer could receive a rebate of rent equal to the majority of the selling revenues, minus the disposal costs, as specified in the lease contract. The lease starts its second phase if the asset is kept. When the lessor and lessee reach an agreement, the agreement will expire. Otherwise, it will end when the asset is sold. The secondary rental, known as a peppercorn rental, may be considerably less than the primary rental, or the lease may be renewed on a month-to-month basis at the same rental. A financial leasing illustration. Finance lease is a financing option that is frequently used to finance cars, especially hard-working commercial vehicles, when a firm wants the advantages of leasing but does not want the duty of returning the vehicle to the lessor in good condition. Finance leases can be utilized for a wide range of assets in addition to commercial vehicles. Here is just one. A fitness center was looking to spend money on new exercise equipment. The entire amount funded was £20,000, and the agreement called for 60 installments of no down payment each month. Importantly, the balloon payment was set to £0, allowing the client, or, more likely, the gym patrons, to utilize the equipment with complete confidence that there will be no financial obligation when the contract comes to an end. After 60 months, the choice will be between selling the equipment and keeping the profit or beginning a peppercorn, secondary, renting period for a relatively low sum. What is an operating lease? An operating lease, in contrast to a financial lease, does not substantially transfer all of the risks and benefits of ownership to the lessee. The lease time will typically be shorter than the asset's entire economic life, and the lessor anticipates that the asset will still have a residual value at the end of the lease. The residual value is anticipated at the beginning of the lease, and the lessor assumes the risk that the asset will reach this residual value at the end of the contract or not. An operating lease is more frequently found in situations when the assets do have a residual value, such as with vehicles, construction equipment, and aeroplanes. The asset is made available to the customer for the duration of the contract in exchange for rental payments. Unlike a financing lease, which covers the entire cost of the asset, these payments do not do so. Operating leases can contain additional services included into the contract, such as a maintenance contract for the vehicle. The asset will be returned to the lessor at the conclusion of the lease, after which the leasing business will either rehire the item under a new contract or sell it to recover the residual value. Or the lessee can keep renting the item out at the agreed upon fair market rate. Although the accounting rules are being reviewed, operating leases are currently a type of off-balance sheet arrangement, and finance leases are a type of balance sheet arrangement. For those using international accounting standards, IFRS 16 will now place an operating lease on the balance sheet. For more information, visit this page. Contract hire is a frequently used operating lease type in the automotive industry. This has been rapidly gaining popularity as the most common way to finance company automobiles. What differentiates operating from finance leases? 1. Title. At the conclusion of the lease term in a finance leasing agreement, ownership of the property is transferred to the lessee. However, in an operating lease agreement, the lessor keeps ownership of the property both during and after the lease term. A finance lease agreement typically includes a balloon, residual clause that gives the lessee the opportunity to pay a set amount to purchase the equipment or property. However, the lessee does not have this choice under an operating lease, although behind the scenes the lessor is setting an internal residual that they have to pay in the future. Using ATO asset criteria, the balloon, residual on a finance lease is determined. 2. Running costs and administration. In an operating lease, all running costs, such as servicing, registration, tires, and insurance, as well as the predetermined period and usage kilometers, are included in the lease for a single fixed monthly repayment amount. In a finance lease, these are typically excluded, which means the lessee may be subject to more administrative burdens and price swings. 3. Account treatment. Previously off-balance sheet, operational leases now appear on the balance sheet as liabilities and right-of-use expenses as a result of the adoption of accounting standard AASB 16 in 2019. This is a change from the previous tax treatment of leases. More information regarding these modifications may be found in our article here. Financing or an operating lease, which is preferable? An operating lease agreement streamlines the end administrative user's tasks and enables them to easily return the vehicle at the end while making a single, easy monthly payment. These are typically effective for businesses that operate at least a few cars because of the administrative savings. In contrast, a financing lease will have extra administrative obligations and, depending on the type of asset and the ATO criteria for the specific balloon, may have some added resale risk for the lessee because you must make sure the balloon amount is reached at the end of the term. Subscribe to this channel, get more information like this.